Hi guys, Max here, and yesterday was actually pretty insane for the markets, as I'm sure you already know, and as I'm sure you can see from this heat map behind me. Big tech companies in particular did absolutely spectacularly well. Microsoft up by almost 7%, Google up by over 7%, Amazon up by 5%, and it was the same sort of story with Tesla, Apple, Facebook, Nvidia, microchip companies. It was just green all across the board. And then in the old world, for the Dow Jones, for example, well, we even saw stocks rise there, with the Dow Jones rising by 1.4%, the S&P 500 up by 2.6%, and the Nasdaq up by an insane 4.3% for the day. Now, we'll go on to talk about just why stocks performed so ridiculously well yesterday, but in short, in very, very short, the Fed came out and hiked interest rates by 75 basis points, and then Powell sort of gave some minor indications that maybe we're past the hump with regards to inflation and Fed tightening, so maybe things are going to get better from here on out. In the rest of the world, it was the same sort of story, just to a lesser degree. Europe was really strong, Americas was strong, Asia was strong, all markets rose for the day, but not by anything quite as much as big tech in the US. The FTSE 100 was up by 0.6%, the Stoxx 600 was up by just about 0.5%, and on the whole, the MSCI World Index rose by 1.9% for the day. Now, as equities did well, it was a risk-on kind of day. Well, the dollar saw a little bit of a weakening, falling by about 0.6% against an index of its peers. The euro rose by 0.9% and is back up to $1.02. The pound rose by 1.1% and is back up to $1.22. And the yen is still sitting at around about 137 per dollar. In the world of fixed income assets and the bond markets then, well, the yield on the US 10-year Treasury fell by 2 basis points down to 2.79%. The German 10-year yield rose by 2 basis points and the British 10-year yield rose by 4 basis points. Now, Treasury yields falling as interest rate hikes come in does seem weird, and it is weird, and really it is wrong. What we saw then was the markets and investors making a lot of huff about some certain things that Powell said and basically predicting that further interest rate hikes in the future aren't going to be quite as drastic, and maybe they'll stop earlier than expected. Finally then, for traditional markets, what happened in the world of commodities? Well, oil prices rose by about 3.3%. WTI crude is now sitting at $99 a barrel, and Brent crude is a fair bit higher at $103 a barrel. So no good news in the oil market, but really it's been far worse in recent memory, so that isn't too bad. Gold prices rose as well by about 1%, up to $1,750 an ounce. And then in the world of crypto, we saw another risk-on correlated day, with crypto basically just shadowing the moves of big tech companies, as we've seen so frequently over the last year and a half actually. Bitcoin up 7% for the day, sitting close to $23,000. Ethereum up over 10% for the day, sitting above $1,600. A really strong day for risk-on assets across the board, and most other altcoins were the same sort of story, rising by anywhere from 5 to 10% for the day. Now, what was the actual news for today that drove all of this? Well, as I mentioned briefly, the Federal Reserve had their Federal Open Market Committee meeting, basically, where they get together and they discuss and they eventually vote on whether or not to change interest rates or the federal funds rate. And they chose for a 75 basis point, a 0.75% rate hike, which is the second one in a row. We've now had 1.5% worth of rate hikes over 2 months, and the federal funds rate now sits at 2.5%, whereas earlier this year it was sitting pretty at 0%. Right now, the debate that's going around amongst investors is whether or not we're going to see increased rate hikes in the future or lower ones. Next month in particular, the debate seems to be between a 50 basis point rate hike and a 75 basis point rate hike. To be honest, I think this is all entirely irrational, and it makes no sense to even consider what we're going to see next until we get this month's inflation data, which we don't yet have. Now, of course, the markets absolutely boomed. You saw how much green there was. Tech in particular absolutely exploded, and that was an insane day of gains. The Nasdaq up by over 4% in one day is not normal and shouldn't be considered normal by any sane person. Now, why did we see such a big gain on what should be historically bad news? Increasing the federal funds rate means that debt is more expensive. It means that it's more difficult to finance growth, and these tech companies need growth to maintain and justify their current valuations. So this should have been bad news for tech companies, no? Well, the idea here is that maybe the markets were pricing in a 1% interest rate hike and this was less than that. So maybe it's good news because it could have been worse. That doesn't really make much sense in my opinion though, because actually the market was pricing in a 75 basis point rate hike according to all available metrics. We also, of course, heard a whole lot from Jerome Powell. He came out and said a bunch of different things, which we will go into detail in a moment. And maybe the markets are now expecting fewer or lesser rate hikes in the future, meaning that that should then be more bullish than they were last week or last month for tech companies. Really though, this is all really hard to say. This is incredibly irrational and markets of course don't make sense right now. They haven't made sense for years now, basically because of quantitative easing and gross irresponsible monetary policy by not only the US government, but mainly the US government. Now, Powell said a fair few different things and the important ones we're going to cover right now. The first is he said, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Now, this was basically interpreted by the markets as Powell saying that rate hikes will stop soon and we're not going to continue these really large rate hikes forever into the future, and the markets absolutely boomed on this news. I think they're reading into this a little bit too much and they're being a little bit too dovish, thinking that Powell is more dovish than he is here because he said other things which sort of contradict this and basically make it clear that he cares about bringing down inflation and rate hikes are going to continue until inflation subsides. Another thing he said was, from the standpoint of our congressional mandate to support maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Now, in my opinion, this was the most important thing that he said because it makes clear what his priorities are. The Federal Reserve is going to fight inflation now, and it's not going to stop fighting inflation until it wins, even if it kills stocks, because the unemployment rate is really strong, so he has a lot of wiggle room. I again think that the markets just mostly ignored this in favor of concentrating on the first thing that he said because that's more bullish and markets like bullish news, and I don't think this is good for the markets. Another thing he said was allowing inflation to become entrenched would be a worse outcome than moving too aggressively. Price stability is what makes the whole economy work. Now, this is true. Inflation will kill the economy, even if the Fed doesn't itself, and this explains their actions. This explains perfectly why he's so willing to damage the economy and to destroy markets in order to fight inflation. Next, he said that the US is not currently in a recession, and the reason is that there are just too many areas of the economy that are performing too well, but avoiding a recession has become more challenging. Now, this is the exact same thing we've heard over recent days from any puppet of the White House. It's the exact same thing that Yellen said, that Biden and the press secretary at the White House has said. Every single government official is parroting this idea that the US is not in a recession. They're telling us to ignore the data and to only listen to their truth and ignore what everything and everyone else says. There were a few other minor things said by Powell. He said that he's going to take this all by a meeting by meeting approach from here, and the Fed is going to stop trying to predict the future and base policy on what they think will happen in the future and only look at what is happening right now, which is basically because they messed up in the past because they failed to predict the future. They got everything wrong, and that's the reason we're in this mess right now. He also said that there could be another unusually large increase that could be appropriate in September of the federal funds rate, that is. And again, this is actually a little bit bearish. It means that another 75 basis point or maybe even a 100 basis point rate hike is on the cards for the next Federal Open Market Committee, and that isn't bullish for markets. Finally, then, he said that he wouldn't hesitate to implement a sharper rise if warranted by economic data. Once again, this is the exact same thing. If things continue to get worse, he could even go higher than 75 basis points and he wouldn't hesitate. This is not dovish at all. This is very hawkish and it shouldn't be good for markets. Now, what's worth noting is that when the last set of inflation data came out about two and a half weeks ago now, it was a brand new high of 9.1%, and instantly the entire market panicked because inflation had clearly not peaked as we'd been told that month, and we'd actually been told the same thing the month prior, and the month prior to that, and the month prior to that. Now, the markets became sure almost immediately that a 100 basis point rate hike was essential to fight inflation at that point. And now, about 3 weeks later, investors totally forgot that that ever happened, and they're now convincing themselves that a 75 basis point rate hike is what was always going to happen. When Bloomberg tells you that the Fed is acting really hawkish, well, you need to remember just 3 weeks back, it really isn't a long time frame. This shouldn't have slipped your memory that 100 basis points was on the cards and was seen as essential. This is actually quite a dovish action by the Fed, in my opinion. Now, either the Fed forgot or they just outright ignored this fact that inflation is still accelerated. But this is just total delusion. Inflation is continuing to get worse, not better. And this peaked narrative has been debunked time after time after time by the very same people who are now telling you that it's been peaking again. We shouldn't let analysts from BlackRock or CNBC or Bloomberg or people like Jim Cramer gaslight us into thinking that things are different to how they actually are. We shouldn't be trading or making investment decisions based on emotion. What you feel should be entirely irrelevant. You should look at the data, look at the actual CPI numbers, look at the actual increases in home prices and in rent prices, because it's so much worse than the markets actually suggest right now. And so we should really try not to get sucked in by the legacy media bubble. Now, the big news for the rest of the week is, of course, going to be the US GDP data that we get out today. Now, it isn't out for me as I make this video right now, but it probably is out for you as you're watching it. Now, there are a few different predictions here. The Atlanta Fed, for example, is predicting a 1.2% decline over the last quarter. The previous estimate from them was a 1.6% decline, so that is a little bit revised. Powell and the Fed seem to think that a small increase in GDP is going to be coming, maybe something like 0.4%. Now, this data is all a little bit backwards. If GDP growth is negative for another quarter, then the US is officially in recession, and that is obviously a bad thing, or usually it would be. The White House, the Fed, and the entire US government, though, has spent the entire last 2 weeks trying to convince you and gaslight you into believing a new definition for a recession that isn't 2 consecutive quarters of negative growth. The reality is, though, we all know this is just false and propaganda, and none of us believe what they have to say anyway, so this really doesn't matter too much. However, in a normal recession, that's bad for the economy, it's bad for businesses. Businesses will make less money, they'll pay their employees lesser bonuses. This will be bad for your job, you might lose your job, and so usually a recession would be really bad for markets. But today it would be good for inflation because it would be a sign of easing price pressures. It would be a sign that demand is falling and supply would have a chance to catch up. So inflation should fall if we actually enter a recession. The markets then would probably determine recessionary data from this GDP report as actually positive, even though historically it would be awful news. The markets might actually agree that negative data today would actually be good for asset prices. Now, on the other hand, if the economy is not in a recession, if this GDP data is actually positive, then historically, again, that would be really good news because recessions are bad, but the deluded markets might actually take this in a positive position anyway because they like to see anything as bullish. But good GDP means the economy is strong and it means inflation is going to remain strong as well. And the only way to stop inflation at this point is basically to cause a crash, to crash the economy. The markets now have been rising at unsustainable rates for 14 years because of inefficient monetary and fiscal irresponsibility by our governments. Quantitative easing and 0% interest rates have meant that liquidity is ridiculously, insanely high, and it's been high for over a decade now. The efficient market hypothesis basically doesn't exist at all anymore, and so we never really know how investors are actually going to react to what should be negative or positive news. Now, we also actually got quite a lot of corporate news out from yesterday. In particular, we had some big companies release their quarterly earnings. Facebook's earnings came out and their share price fell by 5% in after hours trading. So was this a bad report then? Well, yes, actually, for once it was. Their revenue was a miss of $28.2 billion versus $28.94 billion expected. Their earnings was a miss of $2.46 per share against $2.59 per share expected. Their daily active users was a beat of 1.97 billion versus 1.96 billion, but their monthly active users was a miss of 2.93 billion versus 2.94 billion, so nothing stellar there. They saw a 1% decline in year-over-year revenue, which is their first ever decline in year-over-year revenue. And they also saw a profit decline of 2% in year-over-year profit as well, which is again the first time that's ever happened. Now, they did see some costs fall, which is slightly good, but that is really the only good news out of this earnings report. The metaverse revenue is expected to fall over the next 2 quarters as well, which isn't very good. And then Facebook announced that they are slowing down their hiring, and layoffs are actually a possibility in the future as well, but that isn't an essential thing right now. Now, a little bit of a tangent here, but this was a little bit funny to me. Some people really just don't understand the monetary environment that they're in at the moment, and tech employees have always been a little bit special in this situation. So here is a passage regarding the all arms call that Facebook just had with Mark Zuckerberg. Hi there, I'm Gary and I'm located in Chicago. My question is, would Meta Days, extra days off introduced during the pandemic, continue in 2023? Now, Zuckerberg appeared visibly frustrated. All right. He just explained that he thought the economy was headed for one of the worst downturns that we've seen in recent history. He'd already frozen hiring in many areas. TikTok was eating their lunch, and it would take over a year and a half before they had line of sight to overtaking it, and Gary from Chicago was asking about extra vacation days. Given my tone in the rest of the Q&A, you can probably imagine what my reaction to this is. After this year, Meta Days were cancelled. Now, there have just been 150,000 layoffs in this industry in the US alone, and every other company that hasn't already started laying people off is already halting their new hires. Facebook has been hammered. It's trading at a share price similar to where it was back in 2016. It has a PE ratio of under 13, and it's actually a little bit of a great deal in my opinion, but it is facing monumental problems, and these tech employees just don't really understand the new reality of their jobs. The metaverse pivot is stupid and a waste of money in my opinion, and it won't pay off for decades into the future. The company is losing in the short form content game to opponents like TikTok, and it's struggling to monetize its reels as well. They have regulatory risk as they are such a massive company owning Instagram and WhatsApp, and there's a chance of some kind of breakup action in the future. And then to make matters even worse, there's an ad revenue downturn. Twitter and then Snapchat both suffered from it. Then Google suffered from it, and now Facebook's hit as well. This is a very tough year for Facebook, and things aren't looking too bright right now. Now, in contrast to Facebook's bad earnings, we got earnings out from Qualcomm, which is a massive microchip maker, and it was actually a really decent report, but with a poor forecast into the future, and so their share price fell by 4% after hours. Now, their revenue was a beat of $10.93 billion versus $10.88 billion. That's 37% year-over-year growth as well. Their earnings was a beat of $2.96 versus $2.87 expected, and that's about a 50% growth in year-over-year earnings. The forecast for their future, though, was not what investors expected or wanted, and they are disappointed, which is why the share price fell. Now, the company sells microchips for things like phones and cars and other goods all over the world. This is an absolutely booming industry. It's a very popular industry to invest in as well because of the crazy growth that it's seen in recent years, especially. And Qualcomm, being one of the first companies to release earnings out of this sector, is seen as a bit of a bellwether for other big companies like Nvidia and Taiwan Semiconductor. So it's very important. The company is still growing though. It's still having loads of sales and no trouble maintaining in high demand for their products, which is another big reason why actually I think inflation has probably not peaked. This is likely a sign of that. Then we got Ford's earnings coming out, and this was actually strong, so their share price rose by 7% after hours. Their revenue was a beat of $37.91 billion versus $34.32 billion expected. Their earnings per share was a beat of 68 cents versus 45 cents expected. They've tripled their operating income from a year ago, which was way better than investors were looking for, and they're going quite heavy on electric, which seems to be starting to pay off already. Still early days though, but it is looking likely to be a good move by Ford. They didn't make any comments on hiring or layoffs or anything like that, and so layoffs are probably coming, but not quite yet. Now, in a similar sort of vein, Rivian, who exclusively make electric pickup trucks, well, they've just announced that they're firing 6% of their entire staff, and car makers rarely do well in a recession because it's a very difficult industry to turn a profit in. Things might not be quite as strong and as positive as this earnings report initially suggested, but on the whole, this was a good day for Ford. Finally then, the last thing to cover for today is that Best Buy put out some bad news and they're cutting their profit forecast, which is the exact same thing that we've seen happen with Target and Walmart and really every retailer out there. They're all struggling with too much inventory. Customers are spending their money on needs instead of wants because of these ridiculous high levels of inflation, and there's just less profit in those sort of need products as opposed to wants. Now, consumer defensives are typically really strong during recession times, and they're much safer to keep your money somewhere like that than something like a tech company. But this is not a normal recession, and it isn't wise to look back at something like 2008 and that recession to try and predict how this one's going to run out, because everything is different. The name of the game, of course, being inflation, which we haven't really dealt with in about 4 decades. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.